we will address some of the realistic questions of investors, and most important at the moment is recession in the West. Recession. This is one word that's haunting investors since a few months now. And all really want to know, have markets factored in recession or there's more to come? This and many more such real questions are troubling investors and creating hiccups in their wealth creation journey. But what do industry veterans have to say about it? Our next panel discussion is a thought leader panel. We'll discuss on steering portfolio towards continued wealth creation when the world is heading towards recession. It's now time to meet our panelists. Our first panelist is Mr. Prashant Khemka. He is the founder and CIO of White Oak Capital Management. Prior to setting up White Oak Capital Management in June 2017, he spent 17 years at Goldman Sachs Asset Management and has won several accolades as the CIO and lead PM of GS India Equity. He and his fund has won several awards, including AAA rating from CityWire and elite rating from Fund Caliber, among others. In addition to his long-standing India investing experience, he brings a unique perspective derived across developed and emerging market equities and has successfully managed US and global emerging market funds for leading institutions during the last 2 decades. Our next panelist, the Year Award at all the mutual funds where he has worked with Kotak, ICICI Prudential, and Franklin Templeton Mutual Fund. He's a part-time member of the Economic Advisory Council to the Prime Minister. He's a member of the Board of Association of Mutual Funds in India and a member of COBOSAC Committee of SEBI. He's also president of India's oldest Chamber of Commerce with Bombay Chamber of Commerce and Industry in the city of Mumbai. Our next panelist is Mr. Jiten Doshi. He is the co-founder and chief investment officer at Enam Asset Management. He has over 30 years of experience in capital markets, has been with the Enam Group since 1992. He's a regular speaker at global forums on Indian economy like Horasis and has advised several managements on shareholder value creation. Several companies have gone on record to appreciate his contribution in areas such as corporate governance, transparency, disclosure standards, and effective shareholder communication. One more panelist was to join us today, Mr. Ramdev Agarwal, but due to certain personal problems, he was unable to make it. I will now introduce you all to our moderator for this session, Mr. Kamal Manocha. He's a founder and CEO at PMS AIF World. He's responsible for driving the overall business across both wealth management as well as content management. Over past 4 years, PMS AIF World has conceptualized various innovations under his capable thought leadership. The most recent one being the quality, risk, and consistency framework created to deep dive the space of portfolio management services. Kamal brings with him 18 years of experience, holds a master's degree in management and a bachelor's degree in economics from Hansraj College, Delhi University, and many more investment certifications. Over to you, Mr. Manocha.
Thank you so much, Akriti, for such an elaborate beginning. While we miss Ramdev ji, but I am happy that this event is going, very good despite all hiccups. And it is my endeavor, to add a good value in this thought leader panel by moderating this realistically from the point of view of investors. As always, I have tried to ask real questions, and especially in the thought leader panel from all our clients. So, I will first begin with Mr. Prashant Khemka. As my first question that comes to my mind when I put myself in investor's shoe. On one side, we see central bankers taking a lot of steps to increase interest rates to curb inflation. So, obviously, inflation leads to fall in purchasing power. But when one loses job, one loses entire power. There is no power left, right? Because, the rise in interest rates is leading to recession, is leading to layoffs, though obviously this is going to address inflation, but at the end of the day, it is going to lead to a lot of problems. So why is this, self-destructive act of madness being done after 10 years of quantitative easing and now absolutely diagonally opposite step of quantitative tightening? Why can't there be balance in the minds of central bankers? Why do they take so extreme steps that, we have to lay off, we have to kind of, take all such drastic steps? This is the question.
Certainly, Kamal. Thank you for, first of all, the generous introduction and for having me here on your esteemed panel, along with Nilesh Bhai and Jiten Bhai. So thanks again to PMSAI for that. The question that you ask is, central in many walks of life, just not for central banker. If finding the perfect balance for all of us, we all talk about work-life balance, right? Finding portfolio managers seek to find a good balance in the portfolio. So finding the ideal balance is a ongoing process, and you never quite reach there. And the central bankers, obviously, what they had few years ago, according to them, what the right balance at that time, depending on the circumstances at that time. And as circumstances globally evolve, like, nobody could have anticipated COVID, nobody could have anticipated Russia invading Ukraine, and both these, COVID and Russia invasion of Ukraine, have been major sources of supply chain disruption or supply shock even, and that has inflicted higher inflation. In great part, that has inflicted, obviously there are many views as many people you ask, but in many people's assessment, including ours, those two events were major contributors to the inflationary pressures, and both were completely unpredictable. And when events do occur, you have to respond, and hence the central bankers are responding. Tightening is important because runaway inflation is in nobody's interest. So the central banks are taking corrective action to suppress demand. And because supply is not as much in their hand as demand is, so by increasing interest rates, they expect the demand to be somewhat suppressed and bring supply-demand equilibrium again. So what we are finding right now, where we are, from an economic perspective, yes, it would lead to some hardships as the economy slow down, but that is an essential sacrifice in central bankers' minds, and rightly so, to avoid the risk of double-digit or sustained higher inflation. The markets have well anticipated a lot of this. So markets start going down well before, obviously, US markets were down last year big time, even before any recessionary fears were on the horizon. And it is possible that the markets start rallying before even the recession actually starts, in anticipation of a recovery past the recession. So while your question was mainly pertaining to the economic fallout, I just added in the end the market's perspective on the same as well.
Sure, thanks, Prashant. I think you have kind of mentioned a great insight that markets are forward-looking and markets had anticipated all this. So I move on to Nilesh with this insight. What is your view? Is the correction that we have seen over the last 15, 16 months already done, or we are going to see more correction over next, say, 3-6 months? Because, the recessionary fears have been behind us, but actual recession, maybe is in front of us in 2023. And there are all these reports which say that 2/3 of the world could kind of, go in recession, and that could lead to world GDP going down. Obviously, that would impact Indian GDP, Indian capital markets also. But valuations wise, how is India placed at the moment? And what's your view really on this entire pessimism and, market in context of recession going ahead, Nilesh?
Kamal, in the short term, markets are like voting machine. Flows and sentiments determine prices. In the long term, markets are like weighing machine. Fundamentals will determine prices. As Prashant mentioned, markets are forward looking. They have discounted probabilities of recession. As per IMF, 1/3 of the world is likely to face recession. But they have now started improving projections from the bottom. Eurozone projection has been revised upwards as gas prices are now below pre-Ukraine invasion time. So if the actual events happen better than what is projected or priced by the market, then markets will go up. If the actual events are worse than what is feared by the market, then markets will go down. But I don't think so it is possible to predict with certainty, with conviction, how will markets behave in next 3-6 months. When you are entering equity, you don't enter with 3-6 months view. You have to take a longer term view. The world and the economy will continue to give you variety of events, some discounted, some not discounted, some known, some unknown. You have no control over events. You have control only over your reaction to the events. So over next 6 months, if markets fall, that will be an opportunity to buy. If over next 6 months market goes above its fair value, it might be an opportunity to book a little bit of profit.
Sure, Nilesh. I think, I will add that I'm trying to moderate this session realistically, though most of the perspectives are well understood, that markets and equities are meant for long term, but investors always have, questions, obviously, because it's a hard-earned money. And in that context, I kind of, move on to Mr. Doshi. So, Mr. Doshi, I will tell you, though the topic of this particular session pertains to recession and its impact on capital markets, but overall, the theme of this event is India and the resurgence of Golden Bird as we see. And, I have always been reading your articles, and you're obviously very optimistic about India. And, you have been mentioning in your articles, even 6 months ago, that one should be buying quality businesses at every fall. But despite that, quality businesses, growth businesses have been kind of falling. And there is another, I would say, perspective that various fund managers have been kind of claiming that last 10-12 years were good for quality businesses and high valued businesses because there was a quantitative easing era. Now we are in quantitative tightening era, and going forward, these high quality businesses like Titan, Asian Paints, Bajaj Finance, these may, not remain continued consistent compounders, and more value oriented businesses will kind of take over. So what is your view over, say, this decade, where India obviously is in its golden years with regards to these quality and growth focused businesses in this context?
Good evening, Kamal. Thank you so much for having me as a part of your panel discussion. I think it's very simple. Many times we see in the market, it's not the earnings of the business, but like Nilesh mentioned, the flows. So when you get into an over ownership territory and you extrapolate short-term or medium-term earnings and you stretch it to the long term, that's when people tend to start overpaying for these businesses. India is entering a golden decade undoubtedly, and most of the companies that you have just named are the companies that are going to benefit immensely from this trend of the next 10 years, where we see India growing rapidly in a world where most of the countries will have very moderate or no growth. So I'm a great believer that growth stocks will continue to perform. At points in time, there may be periods where they get, overvalued. And I think that's the time that, they pause. But I think the important thing is, in most of these companies, do you have the visibility of the earnings growth? Is the business model durable enough to withstand all the shocks in the external environment? And are these businesses resilient in the given environment of volatility globally? So I think very clearly, it's which point do you see this? If you take the last decade returns for the companies that you have named, for patient investors, they have been the most rewarding companies in over 1 decade. So I believe that, we are here for the next decade. And at any given point in time, I feel these businesses offer very, very lucrative returns if bought at the right valuations. So I think the names will not change. Probably you need to enter them at the right value. And as we have always practiced here at INAM, growth has to be bought at a reasonable price. We are all growth investors. We believe that India is a land of growth in the coming decade. And there is no question about not owning growth stocks. So we are very much for owning growth stocks, but at reasonable valuations and being very patient investors during this period where we believe this will be the golden decade of India, come what may, and however slow the Western world will move, I think it's India's time under the sun. So I think, we will see all these companies, a whole host of bunch of growth companies rewarding investors very well, patient investors who are ready to hold them for at least 5 to 10 years. Nothing will change in that.
Sure, Jiten. Thank you so much for reiterating and reassuring the beliefs that all investors have on these quality businesses. Moving on to Prashant, this question which I asked Jiten is actually a very important question because many HNIs and ultra HNIs have maximum exposure to some of these quality businesses. So I will change the context of this question, but still want to ask you a similar question, that given that we are in recessionary times, and obviously we're talking about the same topic. So obviously we can create a recession-proof portfolio by doing asset allocation. However, let's concentrate on assuming that we are focused only on equity portfolio. So within equity portfolio, if one has to make a recessionary-proof portfolio, how will you kind of like to I would say align between growth and value over next say 3 to 5 years in this decade, given the current valuations? Are you comfortable after the correction of 18 months in these growth stocks, or you still feel that some of the value businesses should be added more to ultimately keep it more recessionary proof portfolio, given that interest rates are also kind of rising? So in this current context, how should one manage and kind of ensure that one continues to create alpha in the portfolio, particularly the equity portfolio?
Thanks, Kamal, for the question. First of all, I would give a caveat, before jumping into answer, that when everyone is worried about a recession, at that point, to build a recession-proof portfolio, I'm not sure whether that is going to serve the desired purpose for any investor. And at any times, even by that, I don't mean that you must build a recession-proof portfolio when nobody is worried about recession. But any time an individual builds a portfolio or any fund manager builds a portfolio for a particular macro outlook, then that portfolio effectively becomes a macro portfolio. You don't need to pick stocks. You are basically betting on a factor risk. And if that factor risk plays out, you can do very well. I mean, as an example, if someone's worried about Indian currency depreciating very rapidly, they may build a portfolio of all the exporters, IT services, pharma generics, and so on and so forth. Now, that's not a stock picking portfolio. It becomes a single risk factor portfolio, which is a currency. If currency goes down, the portfolio would do well. If currency goes up, the portfolio. Such portfolios are high risk without any alpha associated with it, because we at White Oak, at least, we believe that such macro factor risks cannot be predicted, beyond which the market has already reflected in the stock prices through, as Nilesh Bhai was mentioning, in some form of probabilistic risk assessment of this macro events. So certain probabilistic degree of risk of recession is already built into the portfolio. So into the market. So if some investors have some special insight that the recession is going to be far worse than what everybody is worried, then they might make that bet, and that bet, like a coin flip, has a 50% odds of being right or wrong, and the associated risk is very high. It's like during COVID, if you remember, all macro experts and gurus were talking about pharmaceuticals doing extremely well going forward. And possibly because everyone's going to take medicines when they fall sick, everybody's going to take vitamins for avoiding to fall sick, and everybody's going to take vaccine shots, and also pharma in all 3 years. And since the COVID time, pharma has probably been one of the worst performing sectors. So that just again goes to, to the point that building a portfolio based on the current macro environment that you're living in or you're afraid of, which everyone else is also afraid of, usually or generally might not pay off. Having said that, I would say at all times, investors, and as a continuum of what I've just said, at all times, investors, at least we at White Oak, manage a balanced portfolio. Meaning, if the world goes into recession as expected, or if the recession is worse than expected, or if the recession is shallower, or there is no recession as per current expectation, those macro events per se, in and of themselves, should not determine the relative performance of the portfolio compared to the market, if you will. That way, we avoid the factor risk. The portfolio is only truly stock selection driven, stock picking driven, if such macro events in and of themselves are not driving your relative performance. I hope that is making sense. Obviously, if the market goes down big time, the portfolio would also go down big time. If market goes up big time, portfolio also would go up big time. But I'm saying the occurrence of any particular macro event should not in and of itself drive the relative performance of the portfolio, if that makes sense. For that kind of a balanced portfolio, you have to have companies that would do well in a high economic growth environment over the near term. Let's say in a where recession does not occur globally, or in India, the economic growth is very strong. And you also have to have companies which would do well in a modest growth or weaker growth environment in a balanced format. You have to have companies which should do well if currency depreciates or currency appreciates, because there are alpha opportunities in each of these segments of the market. And similarly, there are, what is growth and value? These are words that have been butchered, first of all, by index makers over time. The rank order price to book, cut in the middle. Whatever is high price to book is growth. Whatever is low price to book is value. By that definition, I've seen in the US, all the banks fall under value and all tech companies predominantly fall under growth, except for some weird exceptions, which anyways are weird, right? Now, that's not a good, first of all, description of growth and value. Growth in reality is basically a variable in the value equation. So value is equal to cash flows divided by R minus G, and G stands for growth. So growth is an element or a variable in the value equation. As Jiten Bhai pointed out, growth at a reasonable price. So after building in that growth in your value equation, if there is upside to fair value, then it is worth buying. Otherwise, growth for just the sake of growth is not worth buying. So in the portfolio, you have to have all stocks should be value. All the stocks should have upside. Otherwise, what's the point of owning any stock which does not have upside to fair value? Now, growth can be higher or lower in that value equation. Obviously, generally speaking, where growth is negative or extremely low, generally you don't tend to find value on these companies. That's universal everywhere in the world. So I would just phrase it at that, a balanced portfolio, and growth and value both are part of the same equation.
Sure, Prashant. I firmly agree with you, totally agree with you. However, the problem is when we put ourselves in investors' shoe, investor is paying a fund management fee, and he says, and kind of, his pain point is that over the last 3-4 years, there is no alpha, in the portfolios, be it any fund, be it any PMS, rarely there is an alpha. So I do not know, why that is the case. Yes. And that is my question, to Nilesh. Yeah.
Sorry, I thought that was
sure. So I would like to ask this question to Mr. Nilesh Shah, that why is it that till 2016-17 we used to see many popular funds, be it Kotak, SBI, Motilal, there used to be always alpha, but now over the last 3-4 years, obviously I understand that everybody, specifically all these experienced fund managers, they support bottom up style of portfolio management, and that is exactly what Prashant is also referring to, that one should stay away from top down or a macro focused portfolio. However, those fund managers which follow top down actually have been outperforming over the last 4 years, because they have been taking cyclical calls. They have been kind of they are the ones who actually entered into pharma during COVID period and exited pharma when all other fund managers focus about IT and growth 2 years ago. So but at the same time, what is your view? Do you think as a I would say head of one of the largest asset management company, is there a need for a change in process to bring alpha going forward, or is there any logical reason, and you are aware of that reason why there is no alpha?
Kamal, I don't know whether you can see this or not. I don't think so it's visible, but I was just looking at performance of our funds. Out of 9 + 4, 13 funds, we have been able to deliver alpha to investors for last 3, 5, and 7 years. One of my fund has delivered 11% alpha for last 7 years. So I don't know where you get the data that fund managers are not generating alpha. This is available on our website. Please go to website and check the data. Fund managers are generating alpha, and these numbers are before what happened in A group. So I don't know why this perception is there that fund managers are not generating alpha. Is it to put pressure on fund managers that they start investing in index? I don't know what is the intention. Now, as fund manager, we are adding value to customers, and that's why we are here. I remember reading a SPIVA report in 2005 or 2006, which said that 70% of fund managers don't add alpha, don't create alpha. Do you think investors are so dumb and stupid that for last 17 years, without adding any alpha, they have given us business? Our AUMs have grown 10, 15 times in last 15 years. Do you think they would have given us money if SPIVA report was right? Clearly, there is a pressure on fund managers to go and buy index stocks by making this kind of nonsense comment. Where is the question of data integrity? Our numbers are visible on our website. It is under SEBI regulation. These comments are not under SEBI regulation.
Sure, absolutely. So I agree with this, but obviously the point is there is definitely a perception. Investors
No, perception is what you are making. The truth is something different. SPIVA has been saying year after year that fund managers are not adding value. Then how did our AUMs grow 10, 15 times? Where is this data of showing 11% alpha for Kotak small cap fund for last 7 years coming? After generating 11% alpha, if someone is saying that Nilesh bhai, you are not generating alpha, I don't know what to say. Do people believe that alpha is 11% plus? Where is the question of fund managers not generating alpha? Please show us the data.
Sure. So I was actually referring to some of the PMS products and some of the AIF products, because obviously we are talking about alternatives, and these are HNI focused portfolios. And I was particularly talking about last 3 years, not a long-term track record. I agree, till 2016-17 there has been alpha, and I am myself invested in
5-year, 7-year data only. On 3-year basis also, across my 13 funds except one fund, I have generated alpha. And in PMS and AIF also, where is the data? If I look at our PMS and our AIF, we have added value. Now, more importantly, Kamal bhai, when you compare apple to oranges, for example, in PMS, AIF and mutual fund, most of the time there is open-ended schemes. We keep 5% cash to meet day-to-day redemption. The difference between equity and cash is 7% on an average. So 35 basis point loss happens in a fund because we provide open-ended liquidity, daily liquidity. In index, a fund cannot invest beyond 10% in a stock. In index, you can have Reliance, HDFC Bank, and ONGC and HPCL about 10%. In index, you make a stock enter and exit at closing prices. In the market, that doesn't happen. And finally, globally, when index is compared, for total return index, it is gross of fees performance. In India, we compare TRI with net of fees performance and yet say that fund managers are not generating alpha. So I think people have to talk with data. Just making these global statements are of no value to customers, no justice, not fair to the fund managers.
Absolutely, I agree with you, Nilesh. So this is a statement, which comes from clients, and this is the forum where obviously the statement is well addressed, and especially by a thought leader like you, and that is the intent. I obviously support, whatever you are saying, and in long term, data does convey there is an alpha, but obviously over last 3 years, index has done better than many of the focused portfolios, and that is where there is this apprehension and concern in the
So
mind of
please
some of
call those fund managers who have underperformed the market. Why are you asking me? I have
It-
delivered alpha in PMS, in AIF, in mutual funds. You can ask me, how have we generated alpha? I can answer that. But what we have not done, how can I answer that?
Sure, absolutely.
And Jiten Bhai and Prashant Bhai, I know their numbers. They have also added alpha. I think all three of us are eminently disqualified to answer your queries. You need to get some people who have failed to deliver alpha.
Sure. Absolutely. I was talking in general, but yes, you're right. I agree with you. So, moving on to Mr. Jiten Doshi. So, as I said, obviously the intent of this entire panel discussion is to reinforce the confidence of investor towards equity as an asset class. And, when we started this decade, in fact, started this entire, I would say, process of doing crystal gazing summit, every year, to ultimately keep reinforcing investors' confidence. But this decade started with a lot of hope that this is going to be a golden decade. However, before anything could have transpired, there was a COVID, and now obviously, there is a recessionary fear. We are already kind of 3 years into this year. We understand that over the last 30 years, India's economy has grown from 300 billion to 3 trillion. And in this decade, we were hoping it will cross, from 3 trillion, it will go to 10 trillion. So obviously all these numbers are there. We understand all these numbers, but again, to reinforce investor confidence in 2023, what is your perspective? Do you see at the end of this decade, India's economy will grow from say 3.8 trillion today to say 10 trillion? And if that is going to happen, what is the mathematics behind it? How is that going to happen? What sectors are going to support that? This is the question to you, Mr. Doshi.
Sure. Thank you, Kamal. So interestingly, I have one observation that in no economy of the world, you can grow if the government is not with the businesses and the government is not pro-growth. So after many, many decades, we have a government that understands how growth is to be done. It is facilitating that growth. It is interested in, industrialists coming back and reinvesting, committing capex, creating jobs. Now, I think you must realize that in these 10 years term of the government, first 5 years went to basically clean up the economy. So you must realize that in periods between 2014 and 2019, there was a Black Money Act, there was a RERA, there was a GST that was introduced, there was demonetization. So you must realize that whatever growth we did in that period was despite all these impediments. One can't look in the rear view mirror and start comparing those periods and this decade, which also again after 2019 had COVID, which we managed the best in the world. It also had basically the war where energy prices for a very short period of time went through the roof. I think you really need to realize that India has demonstrated great resilience amongst all the big economies in the world. And there is no more better, I would say, testimony to the growth ahead than your own people putting money and committing huge resources to the ground. If you see a decade ago, or maybe 15 years ago, most of our entrepreneurs had lost confidence in India. And that is the reason that giant size bets were taken by Tata Group, by Birla Group. They were taken, Bajaj went to Indonesia, Bharat Forge went hunting all over the world for companies. And, you had Mahindras that went to Korea. I think all those adventures, all that safari is over. Tatas have lost huge money in Chorus. They have not recovered their investments after a decade in Jaguar Land Rover. Novelis is struggling. Bajaj has shut down the unit in Indonesia. SsangYong has been sold by Mahindras. And Bharat Forge has vacated all those markets. Now, everybody who did not have confidence is today realize that the money should be put in India. Money capex has to go back in India. Tatas have announced $90 billion of capex. Adani Group has announced $100 billion of capex. In this decade, Reliance will do at least $150 billion of capex. The Birla Group will do $30 to $40 billion, including their cement and fiber and retail businesses. So the money is coming back into our country. And, the government has made the environment very conducive. You must realize for big infrastructure to come in the country, you must have interest rates which are, reasonably, decent. And today, I think structurally interest rates have come down. Tax rates, I have never seen a period in 75 years in India where tax rates for a period of 5 years have been stable. This is the 5th year. The coming year is the 5th year where your corporate tax rate will be 25.17%. And during this 5-year period, we have seen a fiscal deficit of 9.5, 9.6% also during the COVID year. But the government has not tinkered with tax. Now, that is the important indicator that they have tried to set the ground. They have tried to give you lots of confidence. Interest rates are low, tax rates are low, inflation is lower than in the West. And I think the West is now going to see structurally a little higher inflation than what they were used to seeing in the last 2 decades. And above all, I think, when you compare against a basket of currencies, we are not that bad. Of course, it's the US dollar which has rallied. So we look as bad as many other currencies versus the US dollar. But I think the entire environment is very conducive for that growth. We are entering a golden period where in the first 5 years of the Modi administration, they have done a cleanup. These 5 years are being used to put a lot of building blocks. And the next 5 years will be full of reforms and growth. And I think the important thing is that the whole world and many countries which had ignored India are today looking at India. We had so many countries that were all China, China, China. And let me tell you, people are disgruntled about what's happened in Russia, Brazil, China. And I think they are very, very satisfied to see that India over these 2 terms of Mr. Modi is demonstrating social stability, political stability, economic stability. We are not a Pakistan. We are not an African country. We are not a Russia run by a dictator. So at the end of the day, I think you are the world's largest democracy. You have the world's largest market of 1.4 billion people. And at the same time, there is a rule of law out here. This is the only country where Kane can freeze the assets of the government and, sort of liquidate those and recover their money. Which other country in the BRICS can you do something like that? So I think the confidence that people have to put investments, it's going to be investment-led growth, both by our domestic entrepreneurs, foreign direct investment coming, consumption going in. You're going to have the PLIs, which is going to see manufacturing grow up, and you're going to see huge exports. I think India is going to demonstrate that it has got the capability to win in several sectors globally. And I think this is going to happen year after year, very, very slowly. I don't think it's easy to take away China's market share in 1 or 2 or 3 years, but over 1 or 2 decades, this is a continuous process. You will see this growth happening. So we are entering the best ever decade. So this decade, I have no doubt in my mind, and I will also want to correct you that, we keep saying that India's economy is 3.4 and 3.5 and 3.6 trillion. Well, I don't know the exact number, but we are not adding the parallel economy. There is so much of black money in the market, even today. There's so many people who don't pay GST. Whenever politicians are raided, you get 25 crores, 50 crores, and 100 crores of cash. So where is all that accounted for? So actually, we are already 4.2 or 4.3 trillion. And from here, I think by F25, you will be 5 trillion. And by F30-31, you will be 10 trillion for sure. And I think this 10 trillion economy, right, will give huge opportunities to people in this country in terms of discretionary consumption, in terms of a capex cycle, in terms of exports, in terms of infrastructure. So it's going to be one of the best places to be present, one of the best places to be staying invested, and one of the best governed countries in this decade. So I think, what we keep saying, Sone ki chidiya, I think that's here. This is India's time. Just be invested and don't look in the rear view mirror, because you see, we have as a population, we have been deprived 67 years prior to what this government came to power. So, there is so much of suffering of the past. There is a huge disbelief. Today, for 2 billion doses of the vaccination being administered, and how 1 billion people being vaccinated in our country, and with every single record, I think nobody in the world has been able to imagine what we have done. So look where our entire tech infrastructure is in the hands of the government at a zero cost to the people, and completely scalable. So I think there are miracles that are going to come out of India. Believe in your country, believe in yourself, and don't let the past hinder your conviction. I think that is the best way forward. I think 10 trillion is only a starting milestone. India has to, like what Mr. Modi has spelled, when we are 100 years young in 2047, we should be 32 trillion by then. So I think let's look at 32 and say that 10 is just one of the milestones in that long journey.
Sure, Mr. Doshi. I think, this is quite reassuring and exactly how, I was expecting. So again, I will go back to Mr. Nilesh Shah. I was reading one of your latest articles, where you have recently mentioned that this year's proposed capex is equal to cumulative capex from 1971 to 2005. This year's enhancement is significantly larger than usual increase of 15 to 25% seen previously. Can you please explain this, elaborate this, for our viewers in terms of, the current budget and what impact it is going to have in terms of, choice of sectors going ahead?
So the impact will be on infrastructure sector where allocation is enhanced. And thanks to election in May 24, there will be higher focus or speed of execution. More orders and faster execution should benefit infrastructure sector. But as Jiten Bhai was mentioning, India is changing. And what we built from 1947 to 2013 in terms of infrastructure is almost getting built in 10 years from 2014 to 2024. For example, we had about 80,000 kilometers of national highway. It is expected that by 24, we'll have 165,000 kilometers of national highway. We had about 225 gigawatt of power capacity. We should be touching 435 gigawatt by 24. We had 600 million tons of coal mining in 13. We should be about 1 billion ton in 24. We had about 20,000 kilometers of railway track electrified in 13. We should be at about 50,000 kilometers in 24. We had 70 airports, mainly larger airports before 13. We'll be at 140 plus airports by 24. We had 50,000 medical seats. We'll be at 1 lakh plus in 24. So essentially, if you want to do in 10 years what you did in 67 years, you have to provide money and you have to execute things at a faster pace. That's what is happening in today's India. This budget is continuing previous budget's work in terms of enhancing allocation to infrastructure, and the whole sector should benefit out of this.
Sure, Mr. Shah, I think this again is quite, I would say, reassuring. And I move on to Mr. Prashant Khemka for this last question. Again, this pertains to India only. All of us are focused on India. The topic for this entire event is India's resurgence as a golden bird. But you are one, unique, I would say, global fund manager. You do not have funds only focused on India. And we are here, obviously, wanting to advise investors for continued wealth creation, not with an emotional and nationalist thought, but obviously with a realistic, perspective. And from that point of view, what's your perspective and what's your advice? What's your opinion over next, say, 3-5 years? Should the portfolio be focused on India, or there are opportunities in other, economies as well? Because recently, over like 3 months, China has given tremendous returns, and there could be a lot of other things, which we may miss by just being focused on India. So over to you, Mr. Khemka.
Thanks, Kamal, for that. So see, India, as Jiten Bhai very articulated very well about the opportunities that exist in India. And I myself, for last 35 years, been invested in Indian equities. Majority of my exposure or net worth is always invested in Indian equities. However, obviously, so I don't invest in debt at all. It's all in equities. A lot of investors do invest in debt as well. And even those who invest in equity invest either across different or various fund managers or funds, or even those who have one fund have more than one stock in the portfolio. They don't just put everything in the top stock or the most favorite stock. So where I'm leading is diversification is always desirable. It is what they call the only free lunch. When you are healthy, you need health insurance. When you're unhealthy, nobody is going to give you. When you're sick, people are not going to give you insurance. So you buy insurance when you're healthy. So the outlook for India is very good, but diversification is a form of insurance. We have, as you pointed out, a GEM or emerging markets, in fact, also an emerging markets ex-India portfolio that we launched, particularly keeping in mind Indian investors, which helps them diversify beyond and yet retain a lot of the alpha potential, because other emerging markets are also highly inefficient, just like India. And if you look at over a 20-year time period, US, India, EM, more or less over long periods of time, most markets provide returns that are in line with their nominal GDP growth rate in local currency terms. Since the turn of the century, all these markets have provided 5 to 6% dollar return, which are all, by the way, far superior than debt investments. So rather than seeking the benefit of diversification by investing a portion in equity and a portion in debt being, in my view, barely earns. In fact, across the world doesn't even earn inflation. So it's a guaranteed real loss, risk-free debt over time. A much better form of diversification could be to diversify in other equity markets around the world. And EMs do offer higher alpha opportunity. And so a certain portion of your net worth is always desirable to diversify. And that is where we come from when we offer EM as a choice.
Sure. Thanks, Prashant. So I will just sum it up, for our audience that, when PMS-AIF World was set up, the belief, in 2018 was that next decade is going to be India's decade. And that is exactly what we have been seeing. Whatever is happening in the West, be it COVID, which happened obviously to everyone all over the world, and be it recession, which is happening to 1/3 of the world, India is turning out as a bright spot. And obviously, inside India, there are a lot of demographics attractiveness, and there is a good policy framework. And obviously, besides that, there is a lot of interest and attraction towards equities and asset class, because a lot of awareness is being spread. And our endeavor through all these discussions and all these, I would say, articulations is to ensure that all the perceptions that investors have, particularly with regards to active fund managers while paying fees, is that they should keep confidence that with a long-term horizon, equities and asset class has always delivered alpha and has always done well. And obviously in long term, it will do well. And next 5, 7, 10 years, especially in this decade, are going to be very robust. And that is the reason we have India. So with these words, I would like to thank all these three speakers for reaffirming and, reassuring the entire confidence. Despite all the, I would say, fears of recession, despite all the, I would say, perceptions regarding, alpha not being there, and look forward to, again, conversing with all of you for kind of getting similar perspective in future. Over to you, Akriti.
Well, things look very, very bright for India. Thank you so much, Mr. Manocha and our esteemed panelists.